So yeah, Randy Smallwood, President CEO, part of the founding team of Wheaton Precious Metals. 20 years ago, this is our 20th year, and so we're quite in a bit of a celebratory mood for a number of reasons, as you can imagine, especially in the markets today in terms of how we're doing. But yeah, we've built basically a whole new industry in the space. I just got to say, I was so happy to catch Paul's presentation on Collective because it is one of the bright stars. Marmato, of course, we've helped fund and are helping fund on a go-forward basis, and so we've been watching that development and very impressed with that, very impressed with Colombia. And so I would say that's one end of the spectrum. What I'm going to now present is the other end of what I would say is the risk spectrum in terms of investing into the precious metal space, and that is the streaming business model, because it's really what we tried putting together when we came up with the original concept of streaming back in 2004. At that time, I was working on Goldcorp, and we needed capital to grow, and trying to figure out how to do that. I mean, you can only issue so many shares, and just the market only has so much capacity in that space. And we literally came up with the concept of selling off our non-core byproduct silver into a separate entity, which at that time was called Silver Wheaton. Took me a few years to sort of recognize the capacity, the potential of that. In 2007, we swung over, and we're now focused in the precious metal space. But we created the streaming business model. And the streaming business model is really, I would say, in the risk spectrum of precious metals investing, definitely the lower risk end of it, mainly because we've taken care of a lot of those risks. And so I better start moving through some of these slides. And I do encourage questions, discussion. I'm here to sort of educate, and so all the way through that process. There will be forward-looking statements. The details are in the fine print and on the website. And just urge everyone to understand the caution around such forward-looking statements. So what is Wheaton? What have we built? Well, the streaming business model is something that I think we've continuing to improve all the time, but it is really a model that's designed to deliver value to all the stakeholders in the space. And that's something that's incredibly important in terms of being successful with responsible resource extraction in today's world, is we can't just focus on the shareholders and the returns. You got to focus on the communities around the mine sites and making sure that you do have that strong social license, that you do have that support. And you've got to focus on your people itself. The industry itself is suffering from a very aging population. There's not a lot of new blood coming into the mining space. Unfortunately, we are starting to see a little bit of uptake in some of the technical schools as people understand that the world needs minerals to survive and needs a lot of minerals to thrive. And so we are seeing that, but it is a business model that I think we've had great success because we don't just focus on our shareholders. We focus on our partners, we focus on our people, and we focus on our neighbors. And it's something that's incredibly important as part of successful business in today's world. The streaming model really allows us to get access to some incredible assets by investing in and buying the rights to a percentage of the production. And because it's a percentage of the production, it makes us an equity investor. We live and die by how well those assets operate. If production's down, our percentage is less. If production's higher, percentage is more. So if you focus on good, high-quality assets and put a real strong effort into the technical side, I think that's what we've successfully done at Wheaton. Just about half of our staff is of technical background, either geologists, metallurgists, engineers, mining engineers, geological engineers. I myself am a geological engineer. I come from the mining industry, built and operated a couple of small-scale but profitable mines in Canada in my as I say, back last century, and social scientists. Just about half of our company has that kind of a background behind it, and so it's incredibly important because when it comes to picking assets to invest into, as I've heard many a wise man say, it's not so much the ones to invest into, it's the ones to stay away from, it's the ones to avoid investing into. And we've got a pretty good track record of not perfect, but a pretty good track record of selecting good assets to invest into. So the high quality assets, that's what we deliver back. 93%, we measure quality by operating margins, and these assets are good, strong quality. The huge advantage and why I describe us as a very low-risk way to invest into the precious metal space is our fixed costs. just about every failure in the mining industry relates to cost overruns, whether it's capital cost overruns or operating cost overruns. And to be honest, inflationary pressures, which sometimes put so much supporting pressure on commodity prices, are also the same thing that drive costs up. And a lot of mining companies tend to operate at relatively consistent margins, no matter what the price is. And sometimes they react slow and don't chase it, and sometimes it goes the other way. It's definitely a much riskier space. In our business, we make an upfront payment for the right to the percentage of that mine, or whatever that byproduct is from that mine. And we make a production payment on a per ounce basis that's agreed to by contract on a go-forward basis. So there's no cost risk back to our shareholders. And that's an important differentiator. That's why I would put us at the end of the spectrum. You really shouldn't own bullion. You should own Wheaton. Because that risk profile is very, very similar to that, mainly because of the quality of the assets and that lack of cost risk. On the upside, of course, commodity price leverage, and even over bullion, we do have that base operating cost of about $400 per ounce that a little bit over $400 per ounce that we pay our partners, and so that does give us leverage. Here's the key: exploration and expansion upside. We get a percentage of what these mines produce for the life of the mine, which in a lot of cases, we've got mines that have operated for hundreds of years continuously. They've never had more than 10 or 15 years of reserves in front of them, but they just keep on exploring and pushing out. We are very close to have actually, even currently, replacing pretty well every ounce that's ever been mined on our projects on a go-forward basis. And so the exploration success has been phenomenal at our operations. And with today's commodity prices and increasing demand, I see even further exploration success, a lot of that. And then, a good strong dividend program. Our company is at a very exciting stage of growth over the next while, and the capacity that we have, I'm actually not sure we're going to be able to invest it into the mining space fast enough, because we are selective about what we invest into. So if it doesn't go into the ground, the dividend grows. Just a quick sort of snapshot of a bunch of our accomplishments over the last while. As I said, 93% of our production comes from the bottom half of the respective cost curve. So that's to say that if I get gold from a copper mine, where does that copper mine sit on the worldwide copper cost curve for the operator? It's not about our profitability. It's about our partners' profitability. And that's incredibly important, because that's the first place that our partners, if it's a high margin mine for them, that's where they're going to reinvest. That's where they're going to spend their exploration dollars. That's where they're going to spend their expansion capital in terms of going forward. That is a huge advantage, especially relative to our peer group, the other traditional royalty companies that are now streaming companies. We have consistently maintained a real strong focus on making sure that our partners have healthy operating margins, strong operating margins. 28 years of reserves. We're a gold company. We're a precious metals company. We get the benefit of these long-life base metal mines, and we're bringing that into the precious metal space. It's something that's not quite recognized, because we got another 10 years of M&I resources and another 20 years of inferred resources after that. Altogether, over 60 years of reserve and resource life out beyond us. That is unheard of in the precious metal space. Precious metals mines usually have 15 to 20 years of reserves, 5 to 10 years of resources. Probably the most exciting segment on this one is the 40% the growth profile we have down in the bottom left corner here. We have made some great investments. Last year was one of our busiest years, 8 new acquisitions, and all of that is feeding into the strongest growth profile in the precious metal space. So the company is in fantastic shape. We've got 42 employees. We're a $25 billion market cap, US dollar market cap company listed on, most of our trading is the New York Stock Exchange, but we're listed here in London on the LSE and, of course, Toronto Stock Exchange in Canada. We're a Vancouver-based company. I live in Vancouver, Canada, but we spend a lot of time around the world. But 42 employees. It's one of the largest market caps per employee of any company on the New York Stock Exchange. We're not heavy on the G&A side, and as I said, nearly half of them are specialists in the technical aspect. So. A whole bunch of other stuff there, but I'll get that. The portfolio, we've got about 30 assets spread around the world, about 20, a little bit over, 18 of them are operating. And you can see just a real America's focus, mainly because we started off as a silver company, and Mexico and Peru are the silver centers of the world. And so the first 10 years was really totally America-centric. But we have spread out. Last year, we finally invested into Africa. We've now got a stream on the Platte Reef mine in South Africa, and we made our first ever investment into Australia with Vista Gold at the Mount Todd. So, key assets for us. Salobo is our flagship asset. It's owned by Vale. It's in northern Brazil. It produces about over 200,000 ounces of gold a year to our credit, just to our share. On a go-forward basis, and so at cost of about $430 an ounce. So it's about 30% of our cash flow. I couldn't ask for a better partner. I couldn't ask for a better jurisdiction. I couldn't ask for a better mine to be our flagship. It's a great asset that's just finishing a third phase of expansion, and Vale is exploring a fourth phase of expansion at that mine. So, Antamina, another well-known mine. Peñasquito in Mexico, number 3, is also a significant producer for us. Voisey's Bay, we get a little bit of cobalt production from the Voisey's Bay mine up in Newfoundland. It's the only non-precious, I would call it the most precious of the base metals, but it's the only non-precious production. We are focused on precious metals. And of course, on the development side, I think probably the most exciting 2 assets is Blackwater's, or Artemis's Blackwater project in BC, and Platte Reef, Ivanhoe's Platte Reef in South Africa, both expected to be delivering metal to us within a year. Streaming works for the entire industry. All the way from Glencore. We've had streaming deals with Glencore since 2006. Or 2005, I think, was the first one that we did with Glencore. All the way down to the small single asset companies. It's a competitive source of capital for the mining industry. It's a very effective, very healthy way to focus on your core franchise and crystallize the value of your non-core byproducts. If there's something that differentiates us to our peer group, which is really Franco and Royal Gold, and there's a number of smaller companies that are in the space, I think this is it. The quality of the asset base, as I said, 93%, 70% in the first quartile. These are the most profitable mines in the world. And as I said, collectively about 60 years of reserves and resources. It's amazing that we've been able to put this together in 20 years to have that kind of a reserve and resource life going forward. And as I said, in today's price environment, that's only going to grow. But this is where the excitement is at Wheaton. We are taking this company to a place that no royalty or streaming company has ever been before in terms of metal production, in terms of cash flows, in terms of revenues. We are getting very close to 1 million gold equivalent ounces a year. Again, remember, at a cash cost on average of around $400 and some odd per ounce on a GEO basis. And that growth, most of that growth is coming from existing assets that are going through either expansions or grade cycling or whatever on a go-forward basis. Half of that is brownfield growth. We just listened to Paul at Collective. Great asset. Marmato is a key asset for us. And the growth that we're going to see there over the next while, very promising. That whole district down there does look good. The Marmato Deeps, we've seen resource growth on that project of 4 times since we made the original investment 4 or 5 years ago. So, even on the greenfield side, Blackwater is very close to producing. Should be. Stephen Dean still promises gold production this year. It will be producing by next year, we know that. Blackwater, Platte Reef, Goose, all good projects. Mineral Park down in Arizona should be up and running within a year and a half. Alex Black at Phoenix, or at Rio 2 with Phoenix, should be up and running. Again, good, strong growth profile. All organic, 40 to 50%. Actually, if you go to 2029, 50% growth over the next 5.5 years. There's not a single mining company in the entire precious metal space, 5 minutes left before questions, I hope, that can show that kind of a profile. This just sort of gives a bit more detail on the growth, and so you can see, again, good, strong assets that will be delivering into that. I'm going to have to accelerate here. Again, the streaming model, the strength to it. This is why it deserves to be at the other end of the spectrum in terms of your precious metals investment. The lack of cost risk. I can tell you confidently that for every ounce of gold that we produce for the next 5 years, it's going to be about $439. Now, I will say some of our streams do have fixed margins of 80% versus fixed costs. If that price goes up, it's only because the commodity price has gone up. But that's a great reason to have slightly higher costs. The other thing I like highlighting here, though, is that we are focused on managing our portfolio. We do sell off some of the weaker assets to make sure that we keep a good, strong portfolio. You can see our costs have dropped by about 10% per year. What mining company in this space, what resource-focused company in this space has actually had cost drops of 10% a year over the last couple of years? And so, this is because we do focus on maintaining a good, strong portfolio. Good, strong balance sheet. We, at the end of the first quarter, had 300 and some odd million in change. This year, we should be generating close to $1 billion in free cash flow, especially with current prices, maybe even a bit over that. What do I lose sleep over? How do I effectively keep that money going into the ground on good quality accretive projects without overpaying? And if it doesn't, it just goes back to the dividend. But we've got a $2 billion revolver. We don't like issuing shares. I apologize for the lack of liquidity on the London Stock Exchange, but we just don't want to issue shares to dilute our existing shareholder base. That is ultimately who we work for. So. You can see the production profile since we created the company and the fact that we're very well suited to crystallize on bull market prices. Back in 2011-12, we generated a spare $2 billion in free cash just with that bull run, and we're producing substantially more metal now than we were then. And so I think we're very well positioned to deliver that back. This is a neat slide because we've actually now surpassed with our cumulative cash flows all the money we've put into the ground. So I think it's kind of significant in the fact that we've got 60 years of reserves and resources in front of us, and we've already paid for what we've invested into. Everything else is gravy, so to speak. So, our cumulative cash flows are now exceeded what our cumulative investments have been. And that's just going to keep on growing, especially with our growth. We deliver more back on a per ounce or a per share of revenue basis than anyone else in the precious metal space through our dividend. And so we've just committed this year. We changed it to being, as a percentage of cash flow, we went back to being a progressive dividend, and so feeding that forward. So mining partners, this is really one slide that I think companies like Collective and others need to keep in mind. The example, there's two main reasons why mining companies should do streams. First off, the arbitrage in value. Precious metals is worth more than us. We share that arbitrage with our partners. But the real key one that a company like Collective should be looking at is the $4 billion that Vale spent building Salobo. We supplied $3.2 billion of that. We supplied 80% of the capital. And we take away currently with the current metal prices. In fact, this hasn't been adjusted for the raising copper prices, but we're about 25% of the EBITDA. Stream always contributes more capital up front than the percentage of revenue it takes away. The net effect of that is a dramatic improvement in the IRR, the internal rate of return, or the return on invested capital, however you want to define it. Vale's shareholders spent a total of $800 million to build Salobo. Every year, they pulled more than $1 billion out of there in EBITDA. That's a great return on their invested capital. Every shareholder in the world is screaming for a better return on invested capital. A stream is a way to take a good mine and make it a great mine. Paul, I hope you heard that. Community, we put a lot of focus. We are architects. We are leaders in this space. We recognize that traditionally royalty companies have never contributed to the success of a project. They just, where's my check? And send the auditors in every once a year or whatever. I had that personal experience myself, and I swore I'd never go down that path. So we have good, strong programs to help our partners be stronger, to give them stronger social license. We co-fund programs. We've built health facilities, improved education facilities, built canals to strengthen irrigation facilities for local farmers, all sorts of sustainability initiatives, all co-funding to help our partners be stronger. The whole objective is to be a partner of choice, and we've got a good track record of that. I think I'm running out of time here, so recognized as one of the top 100 multi-sector companies in the world. There's only actually 2 resource companies that made that list in terms of the global knights. Ourselves and one other mining company were the only 2 that made that list. And so top marks on all aspects. This is an area of constant improvement. We need to do this as an industry to deliver back real value. So, why gold? I don't think I really have to talk much about that, but gold is incredible. Why us? Again, I think that we really compare on the other end of the risk spectrum. Bullion, our risk profile is very low, so I think that's why we should fit that part of everyone's portfolio. Revenue mix, we are pure precious metals. We don't dilute it with any oil and gas, with any iron ore, with any other base metals. We let our shareholders diversify whatever their appetite is. We are really focused on precious metals. I think I'm going to call that the last slide. No, there's one more here. There we go. we check all the boxes. So open for questions, or I don't know if you've got time. Oh, yeah.